Welcome. In this video, we will walk through a high-earning, high-velocity plan to reach financial independence faster. We will build from your robust foundation, like a $35,000 emergency fund and strong 401k growth, and then shift focus toward maximizing tax-advantaged accounts, executing advanced strategies like the Backdoor Roth IRA, optimizing solo 401k or SEP IRA for 1099 income, and deciding when to invest versus pay down a 5.6% mortgage. Along the way, we will address cash flow systems, quarterly tax reserves, and psychological shifts needed to embrace market exposure over cash hoarding. Finally, we will tie it all together with a realistic path to semi-retirement by your mid-50s. Here is our agenda. First, we will confirm the foundation is solid. Next, we will build a tax-advantaged stack. Then, we will walk through the Backdoor Roth IRA steps and compare solo 401k versus SEP IRA for 1099 income. After that, we will cover asset allocation for a long time horizon and discuss whether to prioritize investing versus paying down a 5.6% mortgage. Additionally, we will set up cash flow hygiene with sinking funds and quarterly tax reserves. Finally, we will outline a timeline to financial independence and close with key takeaways and an action plan. Before we begin, this is educational content and not individualized tax, legal, or investment advice. Rules and limits change, and your circumstances may differ. Please consult a qualified CPA or financial planner before implementing these strategies. First, your foundation is strong with a $35,000 emergency fund. That covers several months of expenses and provides resilience. Next, create sinking funds for recurring annual costs, such as insurance premiums, property taxes, and maintenance, so those bills never surprise you. Then, establish a separate high-yield savings account to hold quarterly tax reserves for all non-W-2 income, which helps avoid year-end tax shocks. Ensure you carry appropriate protection, including disability insurance, term life if you have dependents, and an umbrella policy for liability. Implement a pay-yourself-first cash flow system by automating retirement contributions, sinking funds, and bill payments, which forces consistency. Finally, adopt the psychological shift required for long-term success by pivoting from hoarding cash to accepting prudent market exposure, recognizing your time horizon is 30+ years. Next, we construct your tax-advantaged stack. For W-2 income, aim to max your 401k. If you are in a high tax bracket today, pre-tax contributions often provide the best immediate benefits. If you expect significantly higher taxes later, a Roth 401k may be compelling. If your employer plan allows, consider after-tax 401k contributions with in-plan Roth conversions, often called a mega backdoor strategy. If your modified adjusted gross income exceeds the limit for a direct Roth IRA, execute a backdoor Roth IRA by contributing non-deductible dollars to a traditional IRA and subsequently converting to Roth. For 1099 income, a solo 401k provides flexibility, higher potential total contributions, and sometimes Roth and loan options. A SEP IRA is simpler administratively, but can complicate the backdoor Roth IRA due to the pro-rata rule. For rental income, maintain strict separation of accounts, track expenses, and record depreciation while reserving taxes quarterly. Now let us walk through the backdoor Roth IRA process. First, open both a traditional IRA and a Roth IRA at the same provider. Second, make a non-deductible contribution to the traditional IRA and keep careful records. Third, confirm that you have no pre-tax dollars in any traditional, SEP, or simple IRA as of December 31st, because the IRS applies the pro-rata rule across all such balances. Fourth, after the contribution settles, convert the traditional IRA to the Roth IRA, often soon after, to minimize additional gains that would be taxable. Fifth, file IRS Form 8606 to report your non-deductible basis and the Roth conversion. Sixth, if you currently have pre-tax IRA balances, roll those funds into an eligible employer 401k or solo 401k first to avoid pro-rata complications before executing the backdoor Roth. Quiz time. Which step best avoids the IRS pro-rata rule causing unexpected taxes during a backdoor Roth IRA? Option A, making the IRA contribution early in the year. Option B, rolling existing pre-tax traditional, SEP, or simple IRA balances into a 401k before converting. Option C, waiting 12 months between contribution and conversion. Option D, contributing to a Roth IRA directly anyway. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Rolling existing pre-tax IRA balances into a 401k before converting typically removes those dollars from the pro-rata calculation, allowing a cleaner backdoor Roth execution. Timing alone does not fix the issue, and contributing directly to a Roth IRA is not allowed when income exceeds the limit. Let us compare solo 401k with SEP IRA. A solo 401k generally offers higher flexibility by allowing both employee deferrals and employer profit sharing, and some plans offer Roth and after-tax options, plan loans, and the ability to accept roll-ins to clear IRA balances for backdoor Roth purposes. The trade-off is slightly more administration, including plan documents and potential annual filings once the plan reaches a certain size. A SEP IRA is straightforward, with employer-only contributions based on net earnings. It lacks employee deferrals and Roth options, can interfere with backdoor Roth due to the pro-rata rule, and has fewer features overall. However, it is easy and quick to set up. Now, let us set an allocation that matches a 30-plus year time horizon. A moderate, aggressive equity exposure is reasonable, complemented by a measured bond allocation for risk control. Build a globally diversified core using broad index funds or exchange-traded funds to keep costs low. Rebalance either annually or with percentage thresholds to maintain risk targets. Whenever possible, use tax-advantaged accounts first, and place less tax-efficient bond holdings in those accounts to improve after-tax returns. Finally, formalize your discipline in an investment policy statement to guide behavior during volatile markets. This timeline illustrates how the plan unfolds over 2 decades. In years 1 and 2, you focus on maxing the employer 401k, executing the backdoor Roth IRA, opening a solo 401k for any 1099 income, and establishing tax reserves and sinking funds. In years 3 to 5, you increase self-employed plan contributions, fine-tune asset location, and begin modest extra principal payments on the mortgage. In years 6 to 10, maintain a high savings rate, continue disciplined rebalancing, and escalate principal payments if rates remain elevated, while optimizing rental cash flows. In years 11 to 20, you may enter a coast phase where compounding does more of the heavy lifting, keeping contributions steady, and targeting semi-retirement by your mid-50s. This table summarizes key decision levers. First, maximizing the 401k defers income and grows tax-advantaged. Consider front-loading if cash flow permits. Second, the backdoor Roth IRA enables tax-free growth even when income exceeds limits, provided you keep pre-tax IRA balances at zero by year-end and file Form 8606. Third, choose between solo 401k and SEP based on contribution flexibility and administrative comfort, typically favoring solo 401k for high earners with variable income. Fourth, extra mortgage payments deliver a guaranteed return equal to the interest rate and should be prioritized after maxing tax-advantaged accounts. Fifth, reserve quarterly taxes in a separate account to avoid penalties and cash stress. Sixth, automate sinking funds to prevent large periodic expenses from disrupting your investment plan. Turning to the mortgage, a 5.6% rate sets a meaningful hurdle. While diversified equity returns may beat this over long periods, market returns are volatile, whereas extra principal payments yield a guaranteed return. A sensible blend is to first maximize tax-advantaged accounts, and then direct surplus cash toward principal reduction. Consider bi-weekly schedules, or a fixed extra monthly amount to shorten the term and reduce interest. If rates decline significantly, explore refinance or recast options. Maintain sufficient liquidity buffers to preserve flexibility. Here is another quick question. After maxing tax-advantaged accounts, you have an extra $1,000 per month. With a 5.6% mortgage and a 30-plus year horizon, which blended approach aligns best with the plan? Option A. Invest 100% in stocks. Option B. Apply 100% to extra mortgage principal. Option C. Split by continuing to invest per your investment policy while sending a stable portion to extra principal. Option D. Hold as cash in checking. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. A blended approach captures market growth through disciplined investing while also taking advantage of the guaranteed return from extra mortgage principal payments. This follows after you have already maxed tax-advantaged accounts. These are the key takeaways. The $35,000 emergency fund is a launchpad for actions. Maximize your employer 401k and use the Backdoor Roth IRA if your income blocks direct contributions. For 1099 income, favor the solo 401k for flexibility, while recognizing the SEP IRA as a simpler alternative. Maintain a moderate aggressive allocation, automate contributions, and rebalance. Blend investing with extra mortgage principal payments to balance growth and certainty. Finally, maintain tax reserves and sinking funds to keep your plan running smoothly. To summarize, here is a 4-week action plan. In week 1, automate your 401k, open both traditional and Roth IRAs, and establish a solo 401k or SEP IRA if you have 1099 income. In week 2, execute the Backdoor Roth process, ensure pre-tax IRA balances are cleared by year-end, and plan to file Form 8606. In week 3, build your sinking funds and a dedicated tax reserve account, and set safe harbor quarterly estimates. In week 4, implement your target allocation across accounts, start fixed extra mortgage principal payments, and document your investment policy statement. Thanks for watching. If this was helpful, please like the video, share it with a friend, and subscribe for more advanced financial strategies. In the comments, share your next concrete step toward this plan and any questions you want us to tackle next.